Good morning, very good morning to you. It's Rob Stewart with you. Bank holiday Monday. It's early if you're here on the live stream. Amazing, thanks for getting up and watching this. Before I start, for those of you who are on the live stream, if you can see and hear all right, make sure there's no echoes or anything like that. I'm using a new camera setup, so please give me a thumbs up and a comment in the comments box if everything is working all right before we crack on. So, why did I want to get up early on a Bank Holiday Monday and talk about the housing market? Lots been going on over the last week or so. A week is a long time, it seems, in property right now. And I feel like I need to have a little bit of a rant. Usually when I come on and do these market updates and look at the data and crunch through the numbers, I remain fairly objective, but there's a lot going on at the moment which is starting to frustrate me a little bit. And I feel like having a little bit of a rant about policymakers, number one. Number two, about the media and the mainstream media. But also three, about some other influencers as well, and some of the narrative that is coming out from other people with very clear agendas right now. So I want to talk about those. And the two main things I want to focus on in terms of numbers today is, from last week, the inflation, big shock waves gone through the market last week, and also the UK house price index data for March 23 was also released. And I think that's got missed a little bit with all the talk about the inflation. So I want to crunch the numbers about what's going on in the UK HPI and compare it to the other house price indexes, or indices, should I say, so we can see what's actually going on, to be able to, and this is always the point of these live streams, to look at the actual numbers objectively, dive into them so we can make better decisions, or you can make better decisions in your property investing journey. And primarily, if you're here watching this, maybe you're on the live, maybe you're on the replay, this is primarily a channel for property investors who are looking for a roadmap for the next 12 months and beyond. So we need to understand what's going on in the market to make us make better, or allow us to make better decisions. So who we got on? Luke. Hello, Luke. Guys, as we go through, please do ask questions. Even if it's on the replay, if you're watching it on the replay, ask questions. I'll always answer them. And what I tend to do is, as I go through each section, I'll go through the slides, and then we will go back and answer those questions. So please do ask questions as we go in. So good morning. Good to see you, Luke. Okay, so without further ado, let's crack on and crunch these numbers. So let's start with inflation. I'm sure everybody has seen the figures and what's going on in inflation. When I did my live stream last week, I think it was last Wednesday, I talked about the inflation figures are due out, and the forecast, the prediction was about 8.1 or 8.2%. Now, we missed that, and it's up at, I think it's 8.7%. So we missed that by quite a long way, actually. If you look at percentage terms, that's quite a lot of difference, right, compared to what the predictions were. And I do want to say this. Every single time the Bank of England has put out a prediction on inflation, they have been wrong, okay? So this is the first sort of rant about the predictions they put out, how they get reported in the media, okay, and then the actual impact when data comes out and there's a dislocation of expectation, okay, so it's actually different to what we're expecting. That is what causes markets to react. We saw big reactions last week with markets, and it's just like stock prices, share prices. If a company puts out a forward, sort of a trading statement or profit targets and they miss them, markets react badly. So sentiment, and when we're investing in anything, stocks, shares, property, sentiment is such an important part of this process, psychology, understanding what's going on. So anyway, we have come down right from the peak, but that was anticipated because CPI is a rolling 12-month metric. we're losing the big increases in the energy prices from the beginning of last year. So that's expected to be stripped out, okay? We're still above 8%, but the thing that's really causing the jitters is this bit down here. This is core inflation. So it's inflation when you strip out energy and food. So the two biggest things that have gone on are energy and food. By the way, food inflation is still I think about 19%, so still massive. But even when we strip that out, this core inflation, this sticky inflation, is continuing to rise. Okay, and if we actually look at this graph, which kind of zooms in on this core inflation, we can see, it's actually rising quite quickly here over the last reporting period. So this is bad news. This is bad news because with the narrative about inflation falling off a cliff, coming back down to targets, and if you remember, Rishi's target was to halve it by the end of this year. The OBS, we'll look at the slides in a sec. The OBS predicted it was 2 point something by the end of this year. Okay, with this sticky inflation, it's looking increasingly unlikely that that's going to happen. What's the knock-on effect of this? Well, the knock-on effect of this is the only lever they have is continue raising interest rates. We'll talk about interest rates in a bit and the effect that that's going to have on the housing market. Okay. However, this is sticky inflation. It's not going away. If we dive into the detail, I want to have a look at what's actually causing this inflation. Now, this isn't the easiest chart to look at. This is from the full CPI report. Sorry, I'm scratching a lead down here. If we look at the CPIH 1 month rate here, so April 2023, this is what's been reported on. A big rise is alcohol and tobacco. Okay, that's seen a big rise. We've seen a huge rise here in communication. In fact, that's probably that's one of the largest rises there. What we got down here. So yeah, those are the big ones. But you see, these are 1 month, right? So transport, 1.8%. 1.8% is still, almost 20% a year if you pro rata it. Recreation and culture, 1.4%. These are core inflationary items that are going up quickly. Okay. How do we solve it? I saw Jeremy Hunt come out recently, said there's no evidence of companies inflating profit margins, right, to take advantage of it. But when you look at this, it's difficult to start to see any different reality when you start to look at the profits being put out by things like the energy companies, right? Wage price spiral discussions, all of that sort of stuff, right? If profits are going up with some of these companies, okay, then that to me is evidence. And the fact that he has been meeting with food manufacturing, wholesaling to discuss how they can get this under control indicates, right, they believe there is reason, right, that prices are being put up for profit reasons. So I'm just looking, that's quite bright, that light. I might just, how do I unbright that? Don't worry too much about it. If I turn that one off. Sorry, it's a new camera, so I'm just playing around with the settings. That's probably not bright enough. Give me a sec while I just change that. I don't want you to be blinded. There we go, that's better. Okay, so that's what's going on with the CPI inflation. Let's just zoom out of that one. If we put it into this chart, this is a more interesting chart to see what's going up, what's going down. We can see there has been this large drop-off in utilities. So housing and household services includes, for example, energy, utilities. So that's the big drop-off, which we expected. But all of this sort of stuff is still going up. That's not good news. So that's an overview of what's going on in inflation. Okay, I want to talk about why the experts have been wrong about it and why headlines are bad for your financial health. Andrew Bailey has actually come out this week. And by the way, what's your thoughts about inflation? What's your thoughts about where this is going over the next 6 months? Where do you feel we're suddenly going to get it back under control? Do you feel it's going to carry on? That sticky inflation is going to be persistent for longer? If that sticky inflation is persistent for longer, what's going to happen with interest rates, for example? Okay, let's just join the dots and follow it through. So Andrew Bailey came out last week and said the bank admits big lessons to learn over failure to forecast rise in inflation. Now, I don't just want to jump on headlines, okay, but I think they've acknowledged they got these forecasts wrong. Why? Well, let's just see. So if you remember, they said earlier, so this is the OBS, by the way, not the Bank of England. OBS predicted inflation down here by 2.9%. But effectively, when you read what they're talking about, they've got the models wrong. So the models that they've been using, right, have not taken into consideration various triggers, various shocks, things like Ukraine war, or at least that's what they're saying. That's what the narrative is that's coming out to the media. But I think it's quite a big thing for them to come out and say that they've got these models wrong. So does that question the forecasts that are coming through now, and how should that affect the way you look or the decisions that you make based on what's going on? Let's see what their current forecasts are. So this is from the CPI report, okay? So right now we've got Q2 2023, 8.2%. That's where we are. They're now forecasting by Q4 2023, this year, 5.1. Now, interestingly, that's exactly half the inflation figure of when Rishi put out his pledge to halve inflation by the end of the year. So they're forecasting exactly to the decimal point, half of it. That's likely no coincidence. So how reliable is this figure going to be? Is a question that I would put out to everybody, I would pose. And we can see then through next year, 2024, gradually coming down to be 2.3 by the end of 2024. But interestingly, their forecast now, okay, if you look at 25, 1.5, 1.1, 1, 1, 1.1, 1.2. So undershooting that 2% target a little bit. Why do I find this interesting? I put out a video last month, 4 or 5 weeks ago, talking about a possible scenario where inflation did start coming down quickly and the bank were rising interest rates quickly. And don't forget, right, we've got a political pledge here about inflation. The only thing the bank can do is carry on putting interest rates up, right? So if they're sticky, what's going to happen? The chances are, and Hunt's now getting the narrative out about supporting the bank with further interest rate rises. A lot of people were talking, and myself included last week, I thought next month we're going to see a pause. I no longer think that. I think it's pretty much rubber stamped that we're going to get more interest rate rises. We'll talk about that in a sec. However, I did talk about that if it carries on going up, right, if you carry on putting the interest rate rises, because there's so much lag in the system, do we see a scenario where we're going to undershoot that inflation target in the medium to long term, okay, which might then see a rapid decline in interest rates again? And here, I mean, the own forecasts are talking sub 2% in 25 into 26. Actually, if we look at this, again, taken from the CPI report, this is the sort of, they call it a fan, I think it's a fan chart, which is a spread of probability, a quantum of probabilities with CPI. They're sort of in the middle. If you go down the middle, right? Oh, sorry, that's not down the middle. It is going to undershoot their 2% target. We could see here we've got actually potentially minus 2%. So I feel there is still a scenario that in the medium term, when I say medium term, 2, 3, 4 years' time, that we're seeing an overshoot and then a rapid drop in interest rates. But in the meantime, I think we're going to see persistent inflation and persistent high interest rates for a longer period of time. This is going to affect the housing market now. It doesn't matter about 2 years' time. People are coming off fixed rate mortgages now, and we'll talk about that again in a bit. Now, why excuse me, why is it difficult, or why should we take everything we see in the media with a pinch of salt, right? When we see headlines and we see figures, it's easy to latch onto those figures, okay, and go, that's the gospel truth, right? Bailey said it, Jeremy Hunt said it, Rishi Sunak said it, some influencer said it, that's what's going to happen, right? And we make decisions based on this. This is not how the world works, okay? And this is kind of a little bit of a rant I've got, that there's always a quantum of probabilities, okay? There's a range of outcomes, of futures, if you like, that's going to happen. And ultimately, nobody knows exactly what's going to happen. People have models. Bank of England have models, right? But external factors can affect these. So when I look at the future to make decisions, I always look at trends. What are the trend lines, okay? What could alter that trend line? And if there's no data that alters the trend line, we have to sort of make a reasonable assumption that trend is going to continue until we see something in the data or an external event that changes the trend. I want to give you an example of what I mean here. So this is the wholesale gas spot price and forecasting conditioning assumptions for wholesale gas prices from the Bank of England's CPI report, right? So you can see here we've got, what's that, 4, 5 wiggly coloured lines, if you zoom in on this bit, and they're all changing very quickly, okay? We've got August 22 is the orange, which is going high. November 22 is when it's forecast, right, is purple. Feb 23, a lot lower, and May 23, where we are now, right, this pink line, is much lower again. So the environment, the world is rapidly changing, okay, and nobody can accurately forecast what's going on. And by looking at graphs like this, you can see that nobody can accurately forecast. They're putting figures out, but it's rapidly evolving. So you need to be doing the same and thinking about, what does this mean in the future? Let's just take gas, right? Because, by the way, people think there's conspiracies with gas companies. And don't get me wrong, gas companies clearly lobby government to get things, to get more profits. But everyone's like, right, why is gas not as low as it should be in terms of what are we paying gas and electricity? Why is it not fallen off the cliff in terms of our bills, right? If you see the energy price cap is going down, I think it's what, 2,000, going down to 2,000, just over £2,000 a year. I'm not going to go into how that's worked out or what that means. but it's dropped about 33%. But people are going, right, why is it not dropping further? Because the wholesale prices are coming down. You can see here, this was taken just the end of last week when I did the research for this. Wholesale prices, spot prices, right, day ahead gas prices are falling quickly. But we need to understand how the industry works, okay? They're not buying on a day-to-day basis. Companies will be forward buying. So what we need to do is to assess what's going to go on this winter and next year. We need to look at the forward buying prices, okay? If we look at the forward buying prices, this again is winter 23. Right now, forward buying prices are about 140, so that's £1.40 a therm, which is a metric they use to buy, which is hugely less, right, than it was over here at 440, 540, right? So we're now starting to see price reductions, but still not as low as the daily spot price, right? Same with next year. We can have a look at summer 24. We can see still for summer 24 right now it's being bought at 140 a therm. Hugely less than it was last year, right? Less than it was now, but it's still significantly above what the spot price is. Now, if the spot price stays low, this will start filtering in, in maybe a year's time, 18 months' time, 2 years' time. So when the researchers say we're not expecting gas prices to go back to where they were until potentially end of the decade, people are going, what? Why not? It's for reasons like this. Companies are not just buying on the spot price, right? They're forward buying. And therefore, what happens is everything takes longer to filter through the system than anybody thinks. And this, for me, is why inflation is sticking, right? Why nobody forecasts it's going to take this long, because everything takes so much longer to filter through the system. What you see in any sort of boom bust is the boom happens quickly. Let's look at the housing market, because I'm going to relate this to the housing market in a bit. The boom goes up quickly, okay? And then the dip goes on for much longer than anybody thinks. We see it in stocks and shares all the time, okay? By the way, I just thought I'd put this on because on Friday, the actual spot price for wholesale gas, 57, I think it's 57p a therm, which is so significantly, it's 57p or 57 pounds. I'm not a gas expert, right? It's 57 something a therm. I just work out 57 a therm. It was up at 600, 700 last year, right? So it's dropped considerably. And even over the last month, right, it broke the 100 threshold, what's that, sort of mid-April. So we've almost gone down 50% in the last month. Now, it's nothing saying it won't go back up again, right? Spike up, and that's what worried about. It could have extra shocks, supply shocks, go back into winter, but right now it's low. So these things take long to filter through. Now, I want to talk about something called cognitive dissonance and how this affects people. This is a little bit of sort of high performance mindset, high performance coaching. Cognitive dissonance is basically we as humans like to make a mental model of the world about what's going to happen. We have a belief system. And when we internalize a belief system, let's say your belief system is the housing market's going to carry on going up, right? Or your internal belief system is it's all going to crash and it's going to be a horrific, horrible crash. We sort of latch on to that model of the world despite other data that is contrary to our belief system. So one of the reasons I do these lives is to look at the data, challenge the assumptions that we have, okay, challenge the mental models that we're working to, go, right, what's actually going to happen? Let's look at the data, let's try and make an objective assessment of what's going on, regardless of what we want to happen, regardless of what we think is going to happen, let's make an objective decision-making process. So I would say over the last 6 months or so, right, I've seen this horrible sort of fight on social media about property bears, property bulls, people saying property market's going to go up, other people saying it's going to go down. And you can see the internalized belief systems, right, that people have as they come in and argue their cases without actually referring to any concrete data. Or, right, we go down what I'm about to talk about, which is basically cognitive shortcuts. And this is why media mislead us so much and why politicians mislead us so much with headlines that come out, and why influencers can mislead us so much, because we have this thing in our brain called, or a decision-making mechanism called cognitive shortcuts, which we are bombarded with information on a daily basis, right? We've never been bombarded with more information, with smartphones, with YouTube, with all this sort of stuff. And we try and make decisions based on the smallest amount of info. So if we see a headline that says something, right, we'll make a cognitive shortcut and go, that's the piece of data I'm latching onto. I'm going to make my decision based on that without actually taking the time to dive in to what that data means, or what's actually going on behind that data. And therefore, we make bad decisions based on these two things, based on cognitive dissonance, right, and cognitive shortcuts. And I want to give you a couple of examples here, right? And I hope this is useful, by the way. If you find this sort of stuff useful in terms of growing a business, growing a property portfolio, I know we're sort of going quite deep here. We're not just crunching numbers, but I think this is really important to talk about. Just let me know in the comments. Give me a thumbs up or any questions you have on this topic. So I'm going to talk about 2 shares that I invested in lockdown. They were COVID shares. Okay. So one is called ODX, Omega Diagnostics Group, right, and the other is called Novacyte. And you can see both of them did extremely well when we went into lockdown, when COVID came along, right? So ODX is a test. In fact, they're both COVID tests, right? You think, make a mental model. We're in a pandemic. COVID tests are going to do pretty well. Now we've got here this point here, right? The same here. This point here. In fact, let me just take off some of those arrows I put up to make it a little bit more obvious. We've got a point here, okay? And we've got a point here where they reached their peak and then fell off a cliff. Okay, the reason they both fell off a cliff is that was when the vaccine was announced, right, in the UK, the vaccine rollout. So suddenly everyone got the vaccine, COVID is over, and we don't need these tests anymore. So the shares fell off a cliff. But you can see with both of them, right, they fell down and then they came back up. They bounced back up quite heavily. Both of them down, bounced back up. And by the way, I'm including myself in this, that lots of people got caught up in this cognitive dissonance, right, and cognitive shortcuts in that we create this mental model that COVID tests are going to be needed, and of course they're going to be needed. However, when you look at the data, we were buying all of these, millions, billions of tests from China. In US, they were said, no, not fit for purpose. But we've got this internalized system, belief system, that we've got these amazing tests made in the UK, these consortiums, UK-based consortiums, mental model of the world. This is going to be a surefire winner. Okay, and then nothing that then comes out objectively in the data can change that mindset. So both of them bounced, right? Both of them bounced based on bits of information that then put into the marketplace, and almost that cognitive dissonance creeping in by people creating a narrative. And I used to sit there on the share boards, seeing what the chats are going about, creating a narrative about why these would still be needed. It's like, but even though we've got the vaccine, now we'll need these tests to check people after the vaccine. But there was no data to back that up. It was theories, right? And they both bounced up, right? And then when we realised, right, that UK is not going to spend billions of pounds on these things, boom, down they go. Same, boom, down they go. The amount of people that lost huge amounts of money here, more people losing huge amounts of money here on both these shares. All of these people buying here lost huge amounts of money. Okay. Luckily, I came in earlier, right, but didn't come out because of these cognitive shortcuts and cognitive dissonance. And we see exactly the same in the housing market, which is what I want to talk about right now. So, excuse me, how do we translate this to the housing market? This is a headline I found last week. Asking house prices soar to new high. Right move, right? This is last week, 22nd of May. This is 7 days ago. The average price of houses coming to the market rose at the fastest rate in a year, increasing by 1.8% to a record 372,894 in May, property listing platform Rightmove said. If you are susceptible, right, if you have an internalized belief system that the housing market is always going to go up, if you are prone, as we all are, to making cognitive shortcuts, and you read headlines like that, you'll be very inclined to reinforce your internal belief system that the property market, we've had a dip, and we're coming back up now, and things are booming up. And by the way, I'm not saying they are not booming up. We actually don't know. I'll talk about that in a sec. But I suspect they are not. So we need to understand, right, the data behind that. We need to objectively crunch it to understand where that extremely lazy piece of mainstream media reporting has come from, right? These headlines, don't forget, everybody's got an agenda. People, me on YouTube, right? I put a not sensationalist, I put a clickable title and thumbnail on this video because I want people to come here and watch the video so I can talk about objectively what's actually going on. Mainstream media, exactly the same, right? They want clicks. They literally get paid on clicks, right? So sensationalist media, playing to people's belief systems to get people to click and read. But it leads people down the garden path, because imagine if you're now going to go and make a decision to buy a house or buy an investment property on that piece of data, that headline, because you've made a cognitive shortcut and it's reinforced your internalized belief system that might be incorrect, and you then go make a financial decision based on things like this. So what's the reality behind this headline? Okay, our house, is the Rightmove index up? Yes. Objectively, yes it is. But why? What does that mean? So let's look at the house price indices, right? The main ones we've got. So the main ones we've got are UK HPI on the left is the definitive one. Nationwide and Halifax, these two little small ones here, and then we've got Rightmove here. Now these three here, actually this one as well is effectively the same as UK HPI, but England, are based on a model called the hedonic regression model, okay? It's based on actual data. So with Nationwide and Halifax, it's based on mortgage approvals, not completions. Okay, mortgage approval, so they could then fall out of bed. No cash. Nationwide also doesn't cover buy-to-let. UK HPI covers completions registered at Land Registry. So that's the definitive source of data. Rightmove is based on new listing price. New listing price. So it doesn't cover any of the price drops that then subsequently happen. Also, it's not a hedonic regression model. It's basically an average model. So if, for example, you're putting lots of higher priced properties on the market, the Rightmove is going to very clearly show that with an increase in the Rightmove house price index of listing price. Okay, so I've been talking for weeks and weeks and weeks and weeks now, looking at the data, crunching the data, and looking at the migration from big expensive houses into smaller, denser houses for cost of living crisis, increased cost of mortgages. People are downsizing, or people are buying smaller properties for their money, which means bigger, more expensive mortgages, more expensive utility houses are coming on the market more often. Right, I live in a vaguely affluent area, and the amount of properties, £1 million properties, that have come up in this area over the last 6 months is huge. A massive percentage of properties over £1 million have come up on the market. So what is actually more likely happening with that Rightmove data is that it's an influx of expensive houses coming onto the market, not average UK house price is going up. Right, it's a real skew of the data. So that's really important to understand that, right? Big skew of the data. So that's why we need to understand what these indices mean. So, headlines like that are just extremely misleading. However, let's go and have a look, because the UK HPI was out last week. Let's go and have a look at what their main points were on this. Number one, so this is from the UK HPI report, right? I'm just going to read this out. Average UK house prices increased by 4.1% in the 12 months to March 23. So the very first thing it says is house prices have gone up in the last 12 months. Technically correct? Yes, right? But just hold on to that. Second bullet point, the average UK house price was 285 grand in March 23, which is £11,000 higher than 12 months ago. And it does go, but 8,000 below the recent peak. But the first thing it says is 11 grand higher than 12 months ago. Great. Third bullet, average house prices increased over the 12 months, blah, blah, blah. Fourth, the Southwest saw the highest annual percentage change of all English regions in the 12 months. So the four main points on the UK HPI report are all about increases from a year ago. That's mental. That, literally, when I read this, I was like, what? That's how you're framing this data, right? The rolling 12-month is a completely arbitrary metric for two reasons. Number one, 12 months ago is a long time. We all know that 2020 post-pandemic boom, 21-22, right, probably up until summer 22, was a huge growth. We know that, right? So we're comparing something now to what's happening 12 months ago when we know we're in boom. The other thing is UK HPI has a massive lag, huge lag in the system. So this is based on land registry registrations, all right, or property sales being registered at land registry, which can take 6 to 9 months from when that deal was done. So we're talking about March 23. We could be talking about deals that were agreed, or sales, not deals, sales that were agreed August, July, August, September last year. Very, very, with the length of conveyancing's taken 3 to 6 months right now. There's then further hold-ups getting it actually registered at the land registry. This could be 3 to 6 months out of date, potentially even more, this data. So actually we're looking, this 12 months rolling, you're probably comparing it to transactions that were happening in 2021. Okay, how relevant is that? All we care about are the trends right now. Now, I know this is super zoomed out, so I apologize with this being super zoomed out. All we care about are the trends, right? That's the trend. Let me just get the pen back on. The trend is peak and coming down, right? There's a definite topping pattern. This is not just as you see here, right? If I look at this, you've got a market anomaly here. This is when stamp duty holidays changed, right? So you've got a big anomaly. This is a topping pattern right here, right? You can see it in 2008, the same sort of thing. We have no idea where this is going to go. This could go boom like this. It could come back up. I'm not saying, as I always say, quantum of probabilities, right? 3 main probabilities. One is a big crash, like boom. Second is more 90s style, longer drawn out, shallower, which is my personal belief. Although looking at what might be happening with interest rates, I'm starting to maybe think it could be deeper. Or we're just seeing a blip and we're going to go back up. But I'm seeing nothing is indicating to me we're seeing a blip and going back up when you look at the data. Okay, look at the trends, right? This again, UK HPI, this is the annual percentage change. It is falling off a cliff. It's still positive. So when here, they're talking about UK house prices increased 4.1% in the 12 months to March 23, right? Here, we're talking 4.1%. But that's irrelevant. It's the trend that we care about, the trend going down. If we compare it to, this is the nationwide trend, okay? Massive drop-off, huge drop-off in annual house price change. Right, we're now starting to see it in negative on the nationwide. Halifax still slightly positive. UK HPI 4. So I think the Halifax is about 2-point-something%. Nationwide is slightly negative. We're obviously 4% here, but lagging, still coming down. This was the front page of the UK House Price Index on the government on the HM Land Registry. The actual figure for the drop in March is 1.2% on average across the UK. UK, on average, 1.2% drop. That is a large percentage drop across the whole UK. Okay, that's a big percentage drop across the whole UK. Why do I say that? I saw a video by a property commentator, property influencer that I really respect, extremely intelligent person. It was actually a video from about 6 to 9 months ago, where he said there won't be a property crash, there'll be a correction. And in that, he defined a property crash as 10% in a year. So he said, we're not going to see 10%, we'll see a correction. So if you look at inflation adjusted, we're already more than 10% since August last year, inflation adjusted. But let's just say nominal right now, not real house prices, let's say nominal. 10% in a year is about 0.8 something percent every month. Okay, so in the last month, we dropped 1.2%. This is the fourth or fifth now drop in a row on UK HPI. And this is not unusual. If you look at Halifax and Nationwide, they both did the same. Nationwide did 7 in a row and this had 1 tick up. Halifax actually did less than 7 in a row. They had, I think it was 4 or 5 in a row, but they were deeper. And then they had a few rise before another drop. But if you just pro-rata that out over a year, right, that's over 10%. So I believe the last 2, so this is now 3rd in a row, which is over 1% drop. Okay. So that to me, right, is indication of in nominal terms, not even inflation adjusted, nominal terms in excess of 10% a year. If we carry on this trend, that's important. Now let's actually dive into the detail even more. Let's not just look at the headlines here. Let's look at actual regions. So UK obviously includes Wales, Scotland, Northern Ireland. Interestingly, last month, so a couple of months ago, Scotland saw a big dip. Last month, it's bounced up a little bit. It's actually, I think, seen an increase in Scotland. And Northern Ireland has actually been strong as well, because I think it lags England. If you look at England, let's just look at all of these areas, okay, in the last month. Minus 1.2, minus 2, minus 1.7, minus 1.6, minus 1.3, minus 0.4, minus 0.6, minus 4, minus 2.1. Okay, England itself, on average, house prices have fallen 1.5%. Over England. So England is more than the UK as a whole. 1.5% is a lot in a month. Okay, so this is why we need to understand the data, because we also need to understand what's going on in your local areas where you're investing, for example. So where are we going from here, team? this is what I want to finish on before we tie this up, where we go from here. This was the slide I put up last week with the SONIA swap rates, which is the mechanism that banks use for pricing fixed mortgages. And I always kind of use as a comparable the 5-year SONIA fixed swap, or 5-year SONIA swap rate, because I kind of like to compare mortgages based on the 5-year fix. Last week it was at 4.12%, which is the highest I've seen it for a long time. You can see 18th of May it was 4, or 4.05, 19th of April 4.025. So it's kind of been sitting around that 4. If you remember, post mini budget spiked up, then it came down, and everybody's going, interest rates are on the way down, everything's fine, right? Everything's sorted. No reason to worry. See, last year it was at 2%. So that was last week. On Friday, right, that's now gone up to 4.565. It actually overshot a little bit, but I think markets tend to overreact, overshoot, and it came back down, settled 4.565. So that is a difference of 0.4% over the last week. The SONIA swap rate's gone up. Significant amount. You look at what's going on with the banks, nationwide, putting mortgages up by 0.45%. I think most people are now talking about another 2, if not 3 interest rate rises this year. So we're at 4.5. I was thinking we're going to have a pause. I think it would definitely be 4.75 at least next month. And we're now looking like a very real possibility of getting to 5% or above. Okay. I put this graph on quite a while ago. This is from Nationwide Affordability. And interestingly, they always have this red dot here with a mortgage rate of 5.5%, which we could actually be getting to, right? And if we get there, then this is for first-time buyers, all right? But mortgage payments as a percentage of take-home pay will be pretty much the highest or almost the same as it was at the top of the market in 2007. So that affordability is crunching more as the interest rates go up. Compound to that, right, we've still got probably the best part of 800,000 people coming off fixed rate of 2% or less this year. In 2023, it was 1.6 million over this year, people coming off mortgages of sub or 2% or below. And I've been doing some research on this, and actually a lot of people have been thinking interest rates coming off. They've been coming off the fixed rate and sitting on standard variable rate on the hope that interest rates are going to fall in the next 6 to 12 months and then refix end of this year, beginning of next year. Now, if people are doing that, and we're now looking at interest rates going up further, okay, this is compounding the problem again. So let's, when we look at this data, and I just want to sort of, come back over here too. When we look at this data, right, people say there's going to be no property crash, right? There's going to be a supply-demand imbalance, as there always is in the UK, and long-term property prices always go up because of the lack of housing supply. I agree with that, but you've got to look at the time frame. So over the next 2 years, right, is the lack of housing supply going to combat interest rates potentially going 5+%, and all these people coming off fixed rate mortgages of sub 2%, and we've still got sticky inflation. We're still at 8%, which inflation's dropped to wasn't even 2. If it was 1.5%, doesn't mean things are 1.5% lower. It means they're going up at 1.5% less rate, right? We're still going up at 8 point something % a year. Core inflation, food is going up at 19% a year. Core inflation hasn't come down. Core inflation is going up, right? The trends, sorry, I need to do it that way. The trends are still going the wrong way here. So when we objectively look at this data, right, trend for core inflation is still up. Trend for interest rates is still up. People are still coming off fixed rate mortgages. We can look at the energy, and we can look at the forward buying, and we can look at the analytics. And even though, right, the day spot price for wholesale gas is what it was in 2019 right now, that's not what the companies are buying it at. So it's not suddenly we're going to go back to 2019. Look at what the analysts are saying. The cap has gone to about 2,000. It looks like it might go down very slightly in the next one in October, but then tick up a little bit. But it's going to be meaning around 2,000, right? If it means around £2,000 a year, that's over double what it was before the energy crisis, right? You see, last year or last winter, right, the energy price guarantee from the government was put in at 2,500. So if the price guarantee hadn't been there, the cap would have been at 4,500, right? Energy price guarantee, 2,500. I think it went to 3,000, didn't it? But let's just say 2,500 over last winter, and they gave everybody 500 quid. So effectively, if the cap's at 2.5 grand and they gave everybody 500 quid, you're kind of paying 2 grand. We're talking averages here, by the way. 2 grand, which is now what the price cap is, probably over the winter. So it's probably people are going to be in pretty much the same situation this winter than they were last winter. So this is not suddenly going to get better. Wages have been going up, yes, but still below inflation. I think the last print was 6% over the last year. It's still below inflation. Inflation's still bigger than that. So in real terms, people's wages are getting lower. Every trend, if you put sort of a spreadsheet with green boxes and red boxes against all of these things, everything is red. So I cannot, that permutation, that possibility of house prices ticking down and then reversing in the short term, I can't see it. What does this mean for you as a property investor? It means, number one, there's going to be some amazing opportunities over the next 12 months. Also means you don't want to be overpaying, depending on what your strategy is. If you're looking to flip, you're looking to develop, you don't want to be overpaying because there could be that correction, 10%, 15%, who knows? It might not. We might be booming right now. I might have egg on my face in 6 months, and you look at the data and actually, right now, the property prices are going up, 2% a month. I don't know. Could be wrong. But when you look to risk mitigate what you're doing, you have to take these things into consideration. I was working with a client last week, and we were talking about some purchase prices, and he was trying to do a bulk purchase of a portfolio from a developer, and we're looking at the purchase prices, and although he'd negotiated a discount on the open market value, properties hadn't sold, which means they're overpriced. And if you incorporate, let's say, a 10% drop from now, the price he's going, he'd be in negative equity. So the whole principle of buying a portfolio, being able to recycle your funds out by buying a wholesale price, doesn't work if the market corrects. So do you want to take that risk, right? If you're putting all your money into something, look at the risk profile. Yeah, it might work for you over the long term, but in the short term, if you're going to buy something on a bridging product and you need to refinance off that bridge, right, and the market has dropped by 10, 15%, and you're then stuck on a bridge at 1.5% a month penalty or 2% a month penalty, right, you're going to be sticking that whole lot on auction or getting repossessed. So be careful of the prices you're paying. If you're buying something in cash on a yield basis and you don't need to worry about interest rates and you don't need to worry about short-term fluctuations, brilliant, right? And that, for me, is where the opportunity is right now. So there's going to be a lot of people, especially baby boomer landlords and accidental landlords who are getting into trouble financially or just had enough of it and want to exit their portfolios. So the opportunity is there for people who can either do creative, no money down deals with them, or have cash to go in and sidestep interest rates. Because 2 years, 3 years down the line, we could be in a totally different scenario. Okay, we could be in a scenario where inflation is under control, maybe even undershot, interest rates come down quickly, okay, to compensate for that, so we don't go into deflation, right? And that pent-up sort of demand in the property space could then see the next cycle go. So markets contract, expand like a spring. Right now, we're contracting. At some point, you're going to let go, and it'll go back up. So if you can accumulate now, in the right way, in a safe way, not taking silly risks with debt, that's where the opportunity is for me. Lovely. Sorry, I do feel like I ranted a little bit on that, and I feel like I've been on for quite a long time ranting. Over to you guys. What are your thoughts on all of that? Have you got any specific questions on what I've just spoken about, or indeed any specific questions on property market, what you should be looking at right now? Let me know your thoughts, and I'll stop ranting. I'll leave it for 2 minutes. Always take questions. Leave it for a couple of minutes. Let me know your thoughts. So that's useful, by the way, team, to have a look at that data and kind of understanding what's going on. I think my biggest takeaway is policymakers do not have the answer, right? They do not know what's going to happen all the time. When you actually look into their reports, right, their models, they use fan models for everything. It's like, we expect it to be somewhere within this range and this range. Look, I'll show you when. Well, if anybody wants to put questions in. But there's another one that I quite like the look of, right? I found this. I just wanted to show it to you. This is a fan model of their predictions on unemployment. I mean, we're literally in a range from 2% to 7%, right? The published prediction for unemployment in 3 years, 2 years' time, 3 years' time, right, is from sub 2% to over 7%. I mean, I could have drawn that graph. I know there's different, but this is the point I'm making, right? The point I'm making is nobody knows. There's models. It's like the weather, right? How many times does the weather do a forecast and it's not exactly what the forecast said? Just because they say it doesn't mean it's going to happen. Does this mean we can do anything about it? No, but what we can do is we can make better decisions ourselves for how we invest our money. So always look, what's the top side, right? What's my win here? But on the risk mitigation side, what's the downside? Which is why, if you go back and look at my sort of not my lives, my training videos, you'll see that I talk about larger, higher density, higher cash flowing units that you can add more value, more equity, not just like little refurbs, by commercial conversions, right? Apart hotels, things that we've got much fatter margins in to be able to soak up these short-term interest rates. I've got a building, right, that I bought in 2021. 5 flats, leased out to a service accommodation provider and a hairdressers below. I have that on a when I bought it, the mortgage was £1,300 a month, capital repayment. It's about to hit £2,000 a month, okay? And it's still going to be going up. That's £700 a month. That mortgage has gone up over the last 18 months now. Now, the cash flow from that property, sorry, I've got a dog barking in the background. The cash flow from that property is it's just shy of £3,500 a month. Okay, guaranteed come in every month because they're on leases. So at £1,300 a month, right, making great money. At £1,900 a month, £2,000 a month, we're still making over £1,000 a month on it, but those margins are coming down, right? Now, it's not going to be like that forever. My portfolio is also hedged. I have some on fixed rate debt, some on variable. I have hedged. This one's on variable because I bought the business, not the property. So it was basically a base rate tracker was the only thing I could find on a commercial product. We'll talk about that another day. I'm still making money, but less. I'm not happy with that, but I know it's going to come down at some point. Oh, Jenny, how are you doing, Jenny? Good to see you. Good to see you on the live. Great to see you. Luke, awesome live. Thanks. Thank you for the feedback. I appreciate it. So that's my point. So make sure you stress test everything too. Right? If you can get cash, there's still lots of cash out there. People who took C-bills, bounce back loans, still lots of cash out there. This is creating a buffer, by the way, for the whole system, I believe. It will run out at some point, but there's still cash out there. If you can find cash or do things creatively, cash purchase, creative purchase, not leveraging up with very expensive debt, okay, opportunities there. Hugely. One of my clients on Property Cashflow Accelerator last week secured their first deal, 3 flats that a developer has basically run out of money. So they're half done, 3 flats, high yielding, high cash flowing, great purchase price. They'll finish them off. Fantastic. Opportunities out there. Okay, team, I'm going to leave you to it. It's my son's 10th birthday, so I'm going to do pancakes and presents with him. I hope it's been useful. I look forward to. I won't see you next week on the live because I'm actually going away for the next week. So probably 2 weeks until my next live. I hope everybody has a great time over the next week. Hope you're all safe and having fun with life, and I'll see you very soon.